It's too late. It's too late to back out tomorrow. We're already live.
There you go.
All right.
There you go.
All right, folks. Welcome to the channel. Today, I brought my buddy Amar on from Client First Capital. He's a CFA and a CFP. That's just a letter salad to you. If you don't know, that's Chartered Financial Analyst and Certified Financial Planner. I share one of those designations. Because he has his own firm, I do have to point out the disclosure here on the screen that the opinions expressed in this program are for general information purposes only and not intended to provide specific advice or recommendations for any individual on any specific security. It's only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed in this program is no guarantee of future results, and any indices referenced for this comparison are unmanaged and cannot be invested in directly. As always, please remember, investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Client First Capital LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Client First Capital LLC and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Client First Capital LLC unless a client service agreement is in place. All right, that's the disclosure. Okay.
Yeah,
All right.
so
Okay, so we're talking about a couple of different things today. And one of the things we wanted to address is the absolute gangbusters market that we've had today. And let's talk about, for a moment, the statistical significance of the market being up. I don't even know how much it's up right now. It's up like 800 and something points. Where market just closed. It looks like it's up 837. I'm probably getting a little bit of delay here. But how significantly or statistically significant is that? Not very, in my opinion. You probably share that opinion as well. We're in the middle of the bear market, and bear markets are volatile. Any single day's returns don't necessarily matter that much. So we're going to talk a little bit about what a recession is and a couple of different things you should know about recessions and a couple of different things you should know about bear markets, including roughly how many bear market rallies you should expect next, I don't know, 2 to 18 months, however long this recession lasts. So, Amar, why don't you bring
Jason,
up that
your
article
video is
we were
lagging.
looking at earlier? Video always lags.
And your screen is frozen. No,
It
it's
always
back.
lags.
All right.
Okay. Yeah, my video always lags because way down here, close to the border, my internet connection kind of sucks. So, yeah. Anyway, someone will usually complain about it if it's really terrible, but yeah. Why don't you bring up that article that we talked about earlier, where it talks about the things you should expect during a recession, the one by American Funds.
Yeah, it's up on my screen. I don't know if it's. I think you have to share it. You have to share it.
Hold on a second. Add to stream.
Yeah, so this is a good article that American Funds put out. You can find it at thecapitalgroup.com, Advisor Funds. Guide to Recession, 9 key things you should know. And I think like the big thing is, what causes a recession and what is a recession? So this pullback that you see, and I guess this is like a red, but they've made it kind of like purplish red here. These are all parts of the economy when there has been a recession over a period of time. And so typically 2 negative quarters of GDP, declining GDP is what constitute as a recession. Typically markets, when we're in this bear market, will sell off about 20%. Now, recessions are typically 10 months in time frame from peak to trough. And, you erase about 2.5% of GDP growth. And this is normal. This is normal. This is part of the market cycles. Jason, when you and I were advisors, we used to say every 7.5 years, clients would probably not like us so much. And then the rest of the time, they would love us.
That's true. That's true. I actually have some hard numbers here. So there have been 26 bear markets in the S&P 500 since 1928, and there have been 27 bull markets. And bear markets, though, are a lot shorter in duration than bull markets, right? So you're looking at just a few years of bear markets. I think it was like out of 92 years, there were only 21 years of bear markets, and the rest of them were bull markets. So actually, I have those numbers too. So the average length of a bear market is 289 days, or about 9.6 months. And that's significantly shorter than the average length of a bull market, which is 991 days or 2.7 years.
Yeah. So that, I mean, good things to keep in mind. I think like the big thing here is perspective, right? So wanted to show like, what are some indicators that can warn of a recession or where we're at. And the first one is yield curve here. And I use TradingView, and you can put in TradingView the 2s and 10 spread, right? So it's subtracting them.
And we're talking about treasuries, the 2 and 10-year treasury spread.
Yep. Yeah. And so where you see this dotted line, you can see it's crossed back in March, and then it crossed again here in July. When this goes negative, that is a strong indicator that the future economy is out of whack, right? And if you think about it, it makes sense, because if you were lending money to somebody and you're lending for 2 years versus 10 years, you'd expect to get paid more for taking on the risk to lend somebody money for 10 years than you would for 2 years. And this is exactly what it's showing us, that there's a risk imbalance. It's gone negative. When it goes negative, there's a higher probability of a recession.
Right. So typically, though, with yield curve inversions, the recession doesn't necessarily happen right away.
No.
But we had a yield curve inversion last year at this time.
No.
And then it kind of normalized for a bit. And we very rarely had yield curve inversions where we didn't have a recession. 2018 was probably the best example of that.
Yeah. And so just what you're talking about there, I don't know if you can see on my screen because my mouse is frozen, but back, come on.
I can see that back in September, or was that 2019?
Jason, are you still there?
Yep, I'm still here. What's going on?
I don't know. I'm gonna blame my IT.
Yeah. Okay.
Technology, but if I put this back on the screen, does it come up?
Yeah. So Nelly has a question here. So is it iffy to call a recession based on GDP when the year-over-year comps are from 2021 when we were coming out of a pandemic? So yes and no. I think that you have to remember that it's always relative to whatever the numbers were in the previous quarter. It's not necessarily year over year. So we're looking at GDP growth, and we're in a constant growth paradigm here. So yes and no. I mean, we're looking at in terms of the nominal growth of the economy is still very much positive. When you factor in inflation right now, it is actually considered negative, and that's kind of the part of the economy is a little bit hard to understand for people at this point. So,
and I think Nelly's question is like the nuance that coming out of a pandemic, right? So we had this huge low, and then we're bouncing back off of that, and we had this huge growth, and then it went back down again. So I think there is some noise in those numbers, but it's something that when we look at the future numbers is what we're using as a base case effect. So if you use the last year as a base case, then yeah, I can see what you're saying. But typically most financial firms use the last 2 to 3 years of data to kind of compile that. So it's like a rolling average.
Right. So look, the big topic on everyone's mind right now, not just a bear market. One of the things that we say when we're in the financial industry is that is when we work for big firms, is that there's a recession every 7 years. That's actually not true, though. When you look at history going back a lot further, there's typically been a recession every 3.6 years. Part of it is because we're not old enough to remember when finally we get one of those issues that we're not old enough to remember, Amar. So lately that hasn't been the case. I talk to only people that have never lived through a recession. But in the past, those typically occurred every 3.6 years. But since you and I have been financial professionals, it's really been more like an every 7-year kind of deal. So they've been less frequent since World War II. That is true. You could chalk that up to really to Federal Reserve intervention in the economy. You could chalk that up to other things, depending on which side of the fence you stand on. But yeah, so the weird thing is too, also, as I'm looking at this grade we had in the market today, I think it was up like 767 at the end. Something like half of the S&P 500's strongest days in any 20-year period, those occur during a bear market. Like those individually strong days, not necessarily during a bull market. So, and another 34% of the market's best days take place in the first 2 months of a bull market before it's really clear that your bull market has begun, right?
Yeah, so that's an important thing to kind of point out, is that when we think we've hit the bottom, or when we know we've hit the bottom, we're already 3 months down the road, right? Because all the data is, backwards looking. So, we have already hit the bottom before we actually know. And I think that's important to keep in mind.
Yeah. So bear markets are one thing. Inflation is the other concern that I talk about, that I've been talking about lately. It's been a good topic for conversation here. But one of the things that you and I've been discussing over the last couple of weeks has been, how's inflation going to affect people who are saving and investing for retirement?
Yeah. So maybe let's take this in two parts, Jason. Let's first talk about inflation just in the short term here. When you look at inflation, CPI index, almost 35 to 36% of that comes from shelter, right? So CPI is a basket of things that individuals use. Shelter makes up 35% of that calculation. When we look at shelter, how CPI calculates it is based off of rental prices. So the rents being paid, not house prices, rents being paid. And we know that house prices front run rental increases by about 6 months. So right now, the year over year rent increases are still hovering around 6%. And we would think that would stay constant for at least the next 6 months. When we look at that from an inflation perspective, if we know we have a 6% for shelter, and you take 35% of that to make up the CPI calculation, you can see everything else would have to go to zero to have a floor of 2%. And I think this is an important concept to understand, because when the Fed is raising interest rates, their long-term level for the CPI is 2 to 2.5. And there's no way that we're going to be near that amount in the near-term future just with shelter alone. Right. So I think that's really important to keep front and center in terms of when we're talking about this conversation around inflation. The second part, I guess, and I think this is what you're alluding to, when we work with our clients, what are we seeing in terms of work in retirement?
Right.
Is that right, Jason?
Yeah. So a lot of folks that I'm talking to right now, they're retired, maybe thinking about working a little bit part-time, or they're thinking about going back to work in retirement. They're still investing, they're still enjoying their lives, but they're a little bit concerned about how long their income lasts.
Yeah. I mean, I think that it boils down to 4 key categories of people that we see that continue to work in retirement. The first is you have your corporate executive, or you have your business owner, like family business, right?
Right.
That they will always continue to work. That's just how they're wired, right? So they're going to continue to grind regardless. Some of the business owners that I work with, they're in their mid to late 70s and they're continuing to work. And, you may have other family members join the business and your roles and responsibilities may be limited, but you're still involved and it's still occupying headspace. And I think that's important to consider. The second type of individual that we work with that continues to work is more on giving back to the community. So these individuals may have been corporate executives or whatever, and they want to start having a philanthropic impact. Like their second career is being working for a nonprofit in some nature. And so what we see there is typically, you're doing a lot of volunteer work, and then finally one of these organizations needs more consistent help, and you're willing to step up into that role to be actually a salaried employee of that nonprofit. And we see that more of a kind of like a legacy piece to the financial picture. The third area is, sometimes working if you're an engineer and you've grinded it out for 40 years and working, your whole social structure is really based off of your work, right? Like a large part of our friends, like Jason and I know each other because we worked before together, right? It's like, and that's how you build those friendships. And so I would say the third group of people is really just a social piece where they want to stay connected, and a lot of people don't talk about the emotional engagement transitioning into retirement. And what I mean by that is that when you go from working and having friends at work and talking to people and people that you've worked with for like 10, 15 years, whatever the case may be, to suddenly being at home and being in front of a TV or traveling or whatever, once that ends, like then what? Who are you going to talk to? And so like the third group of people, I think they just work more from a social aspect, right? And then I would say I would end with there is a group of people that need to work to make ends meet, and really, when you talk about inflation, this probably affects them the most. But I would also say it's also a lifestyle. So imagine if you're a consultant or something like that, and you're flying and you're at like diamond status on airlines and hotels and everything else like that. And then once you retire, you lose those status points and all that. And then you realize you're paying for these things, and that lifestyle cost just creeps up into something that's unattainable from your savings, right? So this lifestyle creep can happen in retirement, right? It's not only when you're trying to keep up with the Joneses when you're younger with children in the neighborhood and stuff like that.
Absolutely.
So I think, yeah. These are the four I think that we see most often.
Right.
And so how does inflation affect this, right? Because like when you look at a portfolio's withdrawal rate, that when you're investing funds, typically the more you withdraw, the more stress you create on a portfolio, right? And in an inflationary environment, in the environment that we're in now where investments are going down and inflation continues to go up, really squeezes that investor, right? And so like these type of jobs, even if it offsets 10 to 20% of your retirement expenses, has a huge impact on how long a portfolio would last.
Right. So when I go kind of look back at history at other inflationary periods like the 1970s, the Great Inflation, you actually had fairly decent stock market returns in that time period, but it was really underpinned by roughly 40% of the total return of your portfolio back then was dividends. And today that is not true. You're not getting 40% of the return of your portfolio from dividends. So that underlying income stream is kind of missing from there. Additionally, we're seeing a lot of stress in bond markets right now with the vast pool of bonds out there that are issued with like really low coupons. Like I ran like a yield to maturity calculation for a video yesterday, and the bond is trading at like $160 discount or something on a 30-year basis. I couldn't believe it. It's huge.
Yeah.
And it's even more for, depending on how low the coupon rate is. But arranging a portfolio now, when we're talking about investing for the future, let's talk a little bit about your ideas, because it has to be based on total return right now. You can't just invest for dividends. You can't just invest for bond flow. It's really got to be about total return.
Yeah, so and I think regardless of what type of investor you are, if you're looking for growth or if you're looking for income to be recreated, you should always look at total return. That gives you the whole picture, right? And so like if you just look at the income piece and you lost 30% in equity, right? You don't get a whole picture there. Is kind of what I'm trying to say. I think when we look at the equity space, it's very difficult to be invested in companies that have high growth prospects. I mean, like we're extremely defensive, so we're thinking toilet paper, toothpaste, just laundry detergent, just the necessities, like consumer staples, right?
Right.
Another area that we're invested in is utilities, right? And so these all have been hit hard. I mean, there's no safe place to hide, right? Let's make that clear, right? But the pain is relative to the amount of losses that you have, and should be something that you consider.
Yeah, our buddy Josh put out a video the other day. It's one of his first videos I watched in a while, saying that he smells market capitulation happening. It's here or whatever. And I disagreed with that in a live stream. I didn't actually like go on his channel or anything. Money flows look quite a bit different this time around. We're not seeing money leave stocks and go into bonds because of what's happening in the bond market right now.
Yeah, it's going into cash.
It's going into cash where you're guaranteed to lose money, right? It's guaranteed.
Well, real rate of return.
Right. Yeah. I would rather stay invested in stocks and ride out a 9 to 18 month bear market, knowing that I'm going to be back to parity relatively soon, rather than guarantee myself a loss over the next 18 months, in a CD or something.
I think from my experience in 2008, right, as an advisor, I've seen more people get hurt long term by trying to time the bottom of the market or time getting out and then trying to get back in at the right time. More people get hurt by that. And I think you illustrated a key point there is that in that turnaround, I think you said 3 to 5 of the best trading days happen within 2 months of the turnaround, right?
Yeah.
Now, if you miss those couple of days, and then your overall annual return could be jeopardized. So it's very
the
difficult.
difference is really extreme too. Like when Fidelity first did that research in 2005, the return over a 20-year period went from 11.3% annually down to 3.8% annually if you missed the 10 days in a 20-year period of investment. I thought that was pretty significant. And this is research that I talk about all the time. I don't think people really grasp it or care about it that much because whenever I made a video on it, people didn't really like it. But I think nothing made that more acute actually than 2009, right? The bear market was over in 2009 on March 24th of 2009. And the market continued to climb after 2009 or March 24th, pretty much nonstop. Yet the recession didn't end until January of 2010. So fully 9 months before the economy stopped shrinking, the stock market was growing. It made 57% in that time period, which I thought was pretty amazing. And you and I both had clients who got out in January, February, March timeframe, didn't get back into like 2011 or 2012.
Yeah, in fact, I mean, I think this is when I was working at USAA. When we were working at USAA, I had some clients that still had a pile of cash that didn't get back in.
Yeah. Oh, and then, as late as like 2017, they had a pile of cash and didn't get back in. Yeah.
And then they have regret, right? And so nobody can predict the future of prices of the market, but I think we could reasonably say that we can manage the risk that we're taking on, right? And what I mean by that is that as we see these markets decline, you probably want to throttle back the risk and keep cash on hand, right? I mean, that's just, I would say, good practice is to always have cash on hand and
keeping dry powder, so to speak.
Yeah, dry powder. Yeah,
dry powder, so to speak, ready to dollar cost average your way in when everything seems its darkest.
Yeah,
and
when everything seems its darkest, right, is when nobody's going to tell you, hey, this is the bottom, right?
Yeah,
everybody's going to think it's got a lot. It's going to get a lot worse, right? So when the fear is at its peak, it's kind of the time to dollar cost average in. And, buying in from the very bottom or a little bit above, you're still going to get an excellent return over the long run, right? So keep in mind your time horizon being 3 to 5 to 10 years, that these investments, will pay dividends over a longer time frame.
Mm-hmm. Excellent. Hey, man, I wanted to thank you for coming on today. I know you don't have a ton of time. You only had like a half an hour to put into this. Sure. And I'm going to go ahead and continue on without you. And I'm going to talk a little bit about some market stuff today. Just want to let you guys know that Amar and I today, we weren't highly organized. We didn't really discuss.
Our wires got crossed.
Our wires got crossed. Yeah. And I'm going to have him on about once a month. And we're going to take more of a deeper dive into sort of the mechanics of financial planning and how you can help yourself get organized, get ahead, and deal with some of the more complex and nuanced issues of financial planning. Amar is just a friend of mine. I no longer have a professional relationship with his company. And so it's really just as a benefit to my subscribers. So thank you very much for watching today. I'm going to continue on, and we're going to be talking about more market news today. And this is not something Amar wants to do on a live stream. That's cool. So thank you very much, Amar. And we will bring you on next month. All right.
Next month, first Monday of the month. And
first
then
Monday of the month.
I'll connect with you later, Jason. Thank you.
Excellent. Thank you. All right, guys. How's everybody doing? Let's talk a little bit about the markets today. And I'm going to go ahead and share my screen here. And whoops, got to add this back. So yeah, so taking a look at markets today, looks like the Dow was up 764, the S&P 500 up 92, the NASDAQ charging back. Look, guys, like I said, in terms of statistical significance, I wouldn't jump up and down and say this is the beginning of a new bull market or something like that, or this is the bottom or anything like that. During a bear market, there's an average of 6.5 bear market rallies, right? And we've probably been through 3 or 4, depending on how many of these you want to count. So I would expect some degree of bounce back and some degree of pullback. I would expect a lot more volatility over the next coming months, particularly as long as the Federal Reserve keeps raising interest rates. So once the Federal Reserve stops raising interest rates, there's at least one voice out there saying that stocks are going to continue to fall even as the Fed pivots. This is a Morgan Stanley strategist. And let's say that I got to say that he's kind of alone in this assessment. Stocks may see a short-lived bounce on expectations of a Fed pivot. But his opinion kind of dovetails into what I talked about in my last video that I made this weekend, where when we see in earnest quantitative tightening here, where the Federal Reserve starts selling their holdings in earnest, we are probably going to see pretty heavy appetite for those bonds, meaning that as the world economy starts to deteriorate, particularly Europe's economy starts to deteriorate, there's going to be a flight to quality, and U.S. bonds are the place to go. So there's going to be a ready market for us, for the Fed to be able to reduce their balance sheet. In that case, though, that's actually probably going to prop up interest rates. Think about it. If this was a normal economy and the Fed decided to reduce its balance sheet, it would flood the market with these bonds, and there would be not enough sellers to buy all those bonds. You'd see a corresponding decrease in price and a rise in yields, yield to maturity over time. In this case, though, because we're looking at a deteriorating world economy as well, particularly in emerging markets where it's already very expensive to borrow money, now the U.S. is making it more expensive for emerging markets to borrow money. We are looking at interest rates staying high even after the Fed decides to stop raising interest rates. Now, if they decide to lower interest rates again, I still say there would be enough buying pressure to support interest rates on the long term, although we'd probably see a decline in the short term. But this is kind of the most interesting thing about this right here. We're talking about M2, which is money supply here. It's a key measure of dollars in circulation that shows the money supply, what's out there. It's begun to shrink rather precipitously over the last 12 months. And we now have the data to prove that. And the US dollar is very important for the direction of risk markets. And this is why the growth of M2 is tracked. M2 for the big 4 economies, the US, China, Eurozone, and Japan, peaked in March 2021 and thereafter has decreased by $4 trillion. Tracking the rate of change in money supply for these economies is pretty important. The author of this article says it tends to be correlated with lower equity prices, as the chart shows. The contraction in the money supply is happening also when the dollar is trading near its strongest level in 20 years. Right now, and this article goes on to state that this trend has accelerated to about $750 billion a month. Now, I don't know how long that is going to be sustainable. Right now, it's being driven by the 2 factors: rising interest rates and increasing strength in the American dollar. who knows how long that is going to last. So yeah, give me your thoughts on anything you want to talk about in the economy today. I hope that you guys took a look at let me see here. Took a look at the video that I did earlier over the weekend on what the Federal Reserve is likely to do over the next year or so. Let me see here. Given a long enough time horizon, you will still make money over the long run when we're talking about bear markets. It's true. That is true. So, and here's the thing. Like I said, bear markets are normal, but bear markets tend to be short-lived. Like we said, like I stated before when Amar was on there, they're about 9.6 months, and that's a lot shorter than the average length of a bull market, which is about 991 days. Yeah, so in a bear market doesn't necessarily indicate an economic recession, but in this case, I think it definitely indicates an economic recession. The textbook definition of an economic recession is just shrinking GDP in real terms over 2 quarters. We have shrinking GDP in real terms over 2 quarters because we have exceptionally high inflation, but we don't have it in nominal terms. I mean, the economy is still growing at a really fast rate right now, as is indicated by really, really low unemployment rates. Like I think there were only 193,000 claims. Like, in my investing history back in the 1990s, we thought that anything under 350,000 new unemployment claims was great for the economy. That indicated the economy is growing as long as we had under 350,000 unemployment claims. I would actually kind of be not happy. I wouldn't happy to be one of those 350,000 people, but I'd be happy to have 350,000 unemployment claims in the economy right now, as that would be an indication of cooling demand from current levels. So the big thing that I am concerned with right now is the European economy teetering on the edge here due to higher income or higher energy prices, how that is going to crater demand perhaps a little bit too quickly, and how lowering interest rates on the European side may actually be counterproductive to what we're doing here in the United States to fight inflation. Although this is one of the things that's this article talked about, and let me see here. The UN agency warns of a recession linked to imprudent monetary policy. Another important article that just shows you how disconnected these UN agency, whoever this person is at the UN agency is, how disconnected they are from the United States. Excessive monetary tightening could usher in a period of stagnation and economic instability for some countries. Any belief that central banks will be able to bring down prices by relying on higher interest rates without generating recession is, the report suggests, an imprudent gamble. The report said that higher interest rates, including hikes by the U.S. Federal Reserve, would likely have a more severe impact on emerging economies, which already have high levels of private and public debt. So development prospects in a fractured world, this is the name of the report, also warn of a potential debt crisis in the developing world. That looks like, to a degree, that is starting to unfold already. And the current course of action is hurting vulnerable people everywhere, especially in developing countries. So here's the problem with the solutions that this person from the UN suggests. Asked about solutions, she suggested that there are other ways to bring inflation down, mentioning windfall taxes on corporations and better regulations to control commodity speculation and efforts to resolve supply side bottlenecks. 2 out of those 3 suggestions are politically impossible in the United States. We don't do windfall taxes, or at least in today's political environment, that would be almost impossible to do, is have windfall taxes on corporations to help control inflation. Number one, I don't think you can draw a direct line between windfall taxes on corporations and decreasing inflation. Better regulation to control commodity speculation sounds a lot like price controls. Price controls when those were used to counter different inflationary environments, those also caused recessions. Those also caused deflation, which caused people to delay purchases because they thought the price of things was going to continue to decline. And that caused a deflationary cycle, which ended up causing recessions. So those two things are probably not politically feasible in the United States right now. And efforts to resolve supply side bottlenecks, well, that could be anything. That could be the deal that was struck with the Longshoremen's Union on the West Coast. The fact that there's no ships waiting right now. The ports are full, but there's 0 to 1 ships waiting at the port of LA right now is an indication that supply side bottlenecks are starting to calm down. That is not the case on the East Coast. You're still looking at 40 and 50 ships waiting outside of ports, or at least slow motoring there within 50 nautical miles in a lot of cases. So definitely not the case on the East Coast right now, but the situation has improved here on the West Coast when it comes to shipping. And shipping, if you noticed, was one of the things that Elon Musk blamed for not the decline in deliveries. They still had a record amount of deliveries or a record amount of production. He was either record production or deliveries. I don't know. But they were short on deliveries. And a lot of that had to do with the fact that the Teslas that were sold are actually in transit to Europe right now. And that's one of the reasons the stock dropped. Also, I think that the stock dropped just because, hey, there's always a little bit of a hangover after any one of these Tesla special events and after AI Day was around. I wasn't particularly impressed by the robot itself. The jury is out for me in terms of what this humanoid robot actually means in terms of the economy, how it's going to be adopted, how well the AI is really going to work for some basic tasks out there. So I'm going to wait and see kind of mode for this, but I'm quietly hopeful. So so interesting day in the markets today. Markets are up really, really big. Like I said, though, it feels nice. I'm not going to get too excited about it just because I feel like we're going to see a lot more in the way of volatility out there in the next couple of months through the end of the year, possibly in the beginning of next year. What am I doing to counter that? The answer is, as always, nothing. I'm really still buying into the ETFs that I own and still buying some of the stocks that I own as well. My time horizon is a lot longer than the average bear market, which is 9.6 months. I'm happy to grab shares at lower and lower prices. There are a few stocks that I'm concerned with, though, that will never be coming back to those lofty levels they were at before. And a lot of those were the genomic stocks that I've covered in past videos. So the Tesla robot seemed weak compared to the Boston Dynamics robot. So I think the Boston Dynamics robot seems stronger. Just it has a few specific tasks that are programmed in there that are designed to impress us visually. But let me put it to you this way. This is what would convince me that a Boston Dynamics robot is better than a Tesla robot. Put them both in a kitchen and see who can cook me a 3-course meal better. And I don't think either one of them can do it right now. I think you could get a Tesla robot to cook a single hamburger, and that's about it. But I want to be able, if I'm going to get a $20,000 humanoid robot, I want to be able to walk into my house and say, hey, robot, I would like a grilled hamburger, medium rare, because I'm an American. I eat hamburgers every day, according to our European friends. A side of air fried baked potatoes, and some grilled asparagus as well. If it can make me those 3 things, whichever robot does it better, that's the best one. So the Boston Dynamics robot probably looks a little cleaner. So by BD instead of Hyundai. I wonder why Tesla didn't buy Boston Dynamics instead of Hyundai. That's an interesting. So at one point there were rumors of cooperation with Hyundai on a different level, and it had to do with vehicle manufacturing, and those rumors are like from 5 years ago. So I don't know when exactly Tesla robot really became. It probably became a part of the strategy long before it was ever published to us. I know that he first started talking about this maybe about 1.5 years, 2 years ago, but it probably became a much larger part of the strategy before it was ever released to us. So no. So some of the things that Chris, back to your comment here, the Tesla robot seem weak compared to Boston Dynamics robots. So being involved in at least being connected to the defense space for quite some time now, looking at what's available out there in terms of robots, autonomous vehicles, drones, and all that stuff out there, there's a lot of impressive companies out there developing things. It's not just Boston Dynamic. And I think Tesla wants to get in on that. They see that there's a lot going the way with autonomous technology. So, yeah, I understood that was a deliberate choice not to do a lot of things that were too outrageous with AI day. They definitely didn't want the robot falling on their face, and they didn't want another like metal ball through the window type issue. So it was underwhelming in terms of its demonstrated capabilities. But I want to see more before I have a definite opinion on that. So, okay, guys, I am running a little bit of short of time today and running out of a few. Oh, this is the thing that's going to cause Elon Musk to be under the thumb of the SEC forever. This is what he originally got in trouble for, and this is why he originally became. Basically, all of his tweets have to be approved by a lawyer now. I'm considering taking Tesla private at 420, funding secured. So he tweeted that on August 7th in 2018. So as the CEO of a public company like that is publicly traded, when the share price is nowhere near that, and it wasn't at the time, that had a radical effect on the share price. Let's put it this way. If you sold calls on your funds were called away at that price. If you sold puts, your puts declined to nothing at that time. If you had any sort of sale, and this deal ended up not happening. You can't sort of announce things like that. It's against regulations to do that. Tesla and Musk agreed to pay a $40 million penalty, but this is the reason why he's going to stay. He's going to stay under the thumb of the SEC for a long time. Hey, Elon, Ross Gerber says, Elon, I'd love to discuss the long-term global implications of optimism and how investors should view Tesla moving forward. And Elon Musk says, I don't care about boosting the stock, but the economic implications are obvious. Okay. All right. So you can't announce on on Twitter that your economic implication is that the economic implications are obvious, but you don't care about boosting the stock. Granted, he didn't use any specific numbers or anything like that. He's probably actually not going to get in trouble for this tweet whatsoever, but it is something that is going to it is something that's probably not going to encourage the SEC to sort of release him from his mini imprisonment. He doesn't seem to understand that when you are the CEO of a publicly traded company, that your statements in a public setting are seen as company policy. He thinks that the SEC is impinging on his or infringing on his freedom of speech. He doesn't realize that he can't, as a CEO of Tesla, speaking about Tesla in the public square is policy. So, so that's just one of the things going on there. Leo, what's the bottom and fair value price for XPeng? So that's an interesting question. If you notice, I never put price targets in any of my videos for XPeng or anything like that, really for anything. First of all, the company is not profitable. The earliest possibility of profitability would probably be somewhere in the 24, 25 range. And that's when you'd be able to put a fair value on it right now. If you're using something like the price to earnings growth method of valuing XPeng, which is what I would use to do that, and I haven't done that. But that's the only method. That's not the only method, but that is one of the best methods probably to value XPeng. I can't give you one like today, but I may do a video where I work through the price to earnings growth ratio. I've actually been working on one of those videos, and I could possibly I'd have to do it over a long enough time period because they've had really variable growth. But that is the value that is the method that I would use to value that company in particular, is price to earnings growth. And that's the only way to do it because they don't actually have current earnings that can tell you what a fair value is for it. And then when you get the price to earnings growth ratio, you derive a value for the company based on that. You still need to take it with a grain of salt. There is no guarantee that they can replicate the growth of the past. They can do that into the future, right? There never is. So am I happy? I haven't looked at it, but I think I looked at it and the price was something like $12, man. I almost choked. almost choked. So, but yeah, so I've got a couple hundred shares, a little bit under 1,000 shares of XBong at this point right now. I'm eating dirt along with the rest of you guys. My time horizon on that was very, very long. I decided to sell out of most of my Neo investment, and I still have a few hundred shares, but sell out of most of my Neo investment because I was so far up on that. It's okay for me to pay taxes. I have a pathological avoidance of taxes. It's okay for me to pay taxes on that, and okay to concentrate my risk in one company. And I chose XBong for their manufacturing expertise and the breadth of offerings they have in different markets for their vehicles. But yeah, so okay, guys, I am out of time today. I do have to take off. Been getting texts during this from my daughter informing me of what I have to do today. So thank you very much for attending. I will be back on Thursday for sure. It's just going to be me on Thursday, and I'll come a little bit better prepared than we did this time. We just kind of got our wires crossed and didn't really communicate ahead of time. But thank you very much for today, and I will see you guys next time.